Welcome, everyone. We appreciate you coming out tonight. We know it's kind of a dreary night, which helps some of you farmers clear your schedules, allow you to come and learn about some of the new farm tax laws. So I'd like to introduce myself. I think almost all of you know me. My name is Ryan Cook. I'm the CEO at Cook & Company Certified Public Accountants. We're a CPA firm here in Clinton, Missouri, an award-winning CPA firm, actually, and we specialize in solving problems for people. We've been around for over 16 and a half years, and today we're going to talk about the Tax Cuts and Jobs Act, which passed in December of 17, and we're going to focus on the individual and farm pieces of that tax law. I want to introduce a couple of people here that help put this together on our team. We got Chad Jolly back there in the back. He's our Director of Operations. He handled all the logistics for this, so thank you, Chad. And then I've got my wife, Dawn Cook. She works our office as well, so she's here supporting us as well. So thank you all. Everyone should have received a folder when they came in. It has some slides and some other documents. Did everyone get one of those? All right. If you didn't, see Chad. He'll get you one. So there's behind the slides, there's actually a page for you to take some notes if you want to take some notes. So, all right. So we'll go ahead and get started. Presentation, we're probably looking at about 30 to 40 minutes, so we'll try to respect your time and get you out of here in good time. I know most of you came in from out of town, so we want to respect that. So, your second slide in the slide deck has some contact information. So it's got my email address, my phone number. So any questions you get from this seminar, let us know. The plan is to hold your questions till after the seminar. You can catch me one-on-one afterwards, and we'll be glad to tailor our answer to your specific question. So, all right. I always like to start with a little humor, a little tax humor nonetheless. So I don't know if you guys can read all this or not, but it's got a picture of a kid looking at his dad, and it says, "Remember, Dad, those grades are after taxes." So this kid's wise beyond his years. I had no idea about taxes back then, so I wish I would have known that. Sorry, Mom and Dad. I didn't have a better excuse. So just for discussion purposes today, we're going to avoid politics and discussion. A lot of these tax laws we're going to talk about actually expire at the end of 2025. But that's more than 2 presidential elections away, so who knows what's going to happen. So we're going to leave politics out of it, and we're going to focus on individual taxpayers and then some farm stuff as well. So with this new tax law, you can probably expect a lot of delays in filing. And more likely, probably going to be a lot of extensions filed this year. These are major tax changes. We have a mere skeleton of a lot of the pieces of this new tax law. We don't have all the details yet. They're kind of rolling those out here and there. We have some proposed regulations, but we still don't have all the pieces to the puzzle ourselves as practitioners. Just to put it in perspective too, so this is the most significant tax change we've had since the Reagan era over 30 years ago. In the Reagan era, their tax reform, they took 53 weeks to develop their tax reform and get it passed. The most recent tax reform from the Trump administration took 53 days. So you can see kind of why there's some delays and a lot of details are missing. So, and it's also important to point out too that if any year that I've been in practice 17, 18 years total, this is the year to engage a qualified tax professional to prepare your tax return. There's a lot of nuances and tricks to take advantage of. With the new tax law comes a lot of complication, so you can probably expect higher tax preparation prices across the country. Because with a lot of these new provisions, we expect to spend as much or more time on these new calculations than we did just prepare the rest of your tax return originally. So it's also important to point out too, with anything in life, you get what you pay for. So make sure a lot of you are clients of ours, so you've already chosen a good preparer. Congratulations, thank you very much. But if you're not a client, please make sure you engage a qualified tax professional that understands these laws. How are you all? Another thing that we see a lot too is if preparers aren't raising their prices, then they're probably not doing the things they need to be doing to make sure you take full advantage of the law. So garbage in is garbage out. The bottom line is you lose. You're missing out on tax savings. And the reason I tell you all this is because I recently finished serving a 6-year term on the Missouri State Board of Accountancy. I was actually appointed by the governor, and it was the board that regulated CPAs in the state of Missouri, and we also protected the public as well. And so one of my charges on that board was also serving as chairman of the complaint committee. So if any CPAs violated any rules or regulations or did some shoddy work that a client complained about, it came before our committee. And there was a common theme that ran throughout my term on the board and chairman of that committee. There was a direct correlation between price and quality of work and the number of complaints. So most of the complaints came from practitioners who didn't charge enough for their work in the beginning, and since they didn't do the work up front, led to bad results for the client, who was then mad that they didn't get the tax savings they needed. So remember that it's all about value and not about price. Focus on value. That's where it's all at. I'll show you a couple different examples of things that we've just run across within the last year and a half. A couple of horror stories that we actually were able to help and turn into very happy endings for clients. But we had a client come in from another tax preparer. They didn't know anything was wrong with their tax return, but we took a look at their tax return and we were able to find a few modifications and actually save them $24,000 in tax. There was another client that came in and the preparer the year before missed an opportunity that cost the client $60,000 in tax. Luckily, we were able to resolve that issue for them and get them $60,000 back. So these are real life situations that we see, and so I'm telling you this just so you understand that there is a correlation between quality and price. So especially this last bullet point down here, especially with these new tax laws, if you have a business and file a business tax return, if the preparer of that business tax return does not provide the appropriate information on the K-1 form, the individual gets no tax deduction at all from that business. So if you have a business tax return, make sure you're doing business with someone who understands the business tax filings. Otherwise, you're going to lose out on all the new tax deductions from this new tax law. So let's move into the Tax Act itself. So there's several things that are actually not modified at all by the Act, and they include adoption assistance. Retirement plans didn't change much. There's still student loan interest deduction. We'll talk about all these in more detail here in a little bit later. Some other things that are unmodified include education assistance. There's an electric car credit out there. Not many people actually benefit from that because it's pretty narrow. One thing that a lot of people do take advantage of is this gain on the sale of their home. So that's still within the tax laws. So you can exclude the gain on the sale of your home if you meet certain specifications. Here's kind of a side-by-side comparison of the old rates before the tax change for 2018 versus the new rates. You can kind of see across the board that there's roughly a 2 to 3% decrease in tax rates. So most people across the country are going to be paying less tax as a result of that. The personal exemption is now 0. We'll talk about that a little bit later. The personal exemption was actually replaced with a doubling of the standard deduction and a doubling of the dependent care credit or dependent credit for children under the age of 17. It also eliminated the phase out of the dependent credit and added a new credit for other dependents as well. So prior to 2018, about 30% of tax filers actually itemized their deductions. Both the new tax law, the standard deductions increased significantly. So if you're married and file a joint tax return, before the new law, you actually received a $13,000 standard deduction, and now you get a $24,000 standard deduction. And you can see that singles and head of households were also impacted too. So there's a significant increase in standard deductions, which leads to this next bullet point. So the number of people who actually itemize their deductions are expected to drop by 60%. And so only about 12% of taxpayers are probably going to itemize their deductions now. And this is good for the general population as a whole because tax returns for a lot of the population are going to get easier unless you have a business. So and we specialize in helping businesses, so that's why we're here today, let you know that this is available. And just remember too, you also get the greater of the itemized deductions or the standard deduction. So that did not change. So this is the old way of figuring deductions on your tax return. You got to deduct the greater of your itemized deductions, which include medical, state and local tax, mortgage interest. You can see this list is pretty lengthy under the old law. And you took the greater of the two. Under the new law, you said this is a little bit shorter list now, and we'll talk about the details of that here in a little bit as we talk through. But the standard deduction doubled, so most people are still going to come out equal or better, even though that list got shorter of itemized deductions. So what did change within the laws? There's still some things that didn't change, like medical expenses. The definition of those still stayed the same. Taxes are now limited to a $10,000 deduction if you itemize. Mortgage interest is limited. Home equity lines of credit and interest you pay on those are limited now. Charity is unchanged. So several things that are unchanged. Right down here, the miscellaneous itemized deductions, those are completely eliminated, and that's going to have a big impact on a certain segment of the filers. And then people, whenever they used to itemize deductions, if your income was at a certain level, then you actually lost out on some of your itemized deductions, but they eliminated that phase out, and so even high income people do not get their itemized deductions limited anymore. So what we're seeing for 2018, well, we expect about 80% of the individuals to pay less tax. And that stems from several different things. So we've got lower tax rates, we have wider tax brackets, we have dependent credits and minimal phase out on some items. And then most people don't realize this, but when we prepare a tax return, we actually prepare a tax return under two different tax systems. There's the regular tax system and then what we call the alternative minimum tax system. And so the AMT, there's been some changes to it that kind of mostly take it out of play. But there are also going to be about 20% of the population that are going to pay more tax. And those are people that have a lot of kids. So since the personal exemptions are gone, if you have a lot of kids, you're going to miss out on that personal exemption, and you're going to probably pay more tax. And then if you have a lot of mortgage debt due to the mortgage interest limitations, you're going to be paying more tax. So a lot of the buzz around this new tax law, people were talking about this new 20% deduction. And this was kind of in response to the change in corporate tax rates. So a lot of corporations, their tax rate got reduced from the highest corporate tax rate of 35% down to a flat 21%. So the people who weren't organized as corporations were kind of like, well, what's in it for us? You know, if corporations are going to win, our businesses that aren't corporations need to see some benefits too. So they created this section 199A, which essentially is a 20% deduction against your business income or your taxable income, whichever one is lower. But you'll notice here too that there's also some phase outs. So if your taxable income hits certain thresholds, you might lose out on some of that 20% deduction. And we'll talk about that more in a little bit too. Let's slide over to some of the farm-specific items within the new tax law. So farmers, obviously they're a small business, they get to benefit from this new 20% deduction as well. So most farm income, so if a farmer's in the active trader business of farming, they're going to report their farm income on what we call a Schedule F. So a farmer's net income on a Schedule F is going to qualify for this 20% deduction. So as long as 20% times your farm income is lesser than 20% of your taxable income, you're going to get a pretty good deduction. Farmers also get a 20% deduction against what we call Section 1245 ordinary gain, and that's just a fancy term for if you bought a piece of equipment, you depreciated it, sold it at a gain, the depreciation that you took on that caused the gain is going to qualify for this 20% deduction. So that's all that's saying. And then similar to what's happened in the past, co-ops, they used to issue a domestic production activity deduction to their patrons, called a patronage dividend. And co-ops still have the ability to do that, so they can still pass through some of their 20% deduction. Some farmers have multiple entities, or they might have an entity that's an operating entity that operates the farm, and they might have a real estate company that holds the land, and the real estate company and the operating company pay rent back and forth to each other. So under this new law, there could be some disadvantages by having separate entities, but the law allows you to actually aggregate those entities into one for the computation of this 20% deduction. It's important to note out too that this aggregation works best for farmers that have a high income. So if you have a low income, there may not be any benefit to aggregating. A couple of the biggies related to farms: equipment trades. Equipment trades may now trigger a taxable gain, whereas before they most likely didn't. So just an example, let's say a farmer had a tractor, and they took that tractor and traded it in at the dealership, and the dealership allowed a $100,000 trade-in, and the new tractor cost $200,000. So there's a $100,000 net difference that the farmer was paying on that new tractor. So under old law, the $100,000 trade difference hit the depreciation schedule, and we depreciated it. So the farmer never reported the sale on the trade of that equipment. It was just treated as a like-kind exchange. There was no reporting of the sale. Under the new laws, however, the tractor being traded in is reported as a sale for the trade-in value of $100,000, which goes on a schedule that's not on the farm schedule. And then the $200,000 piece of $200,000 tractor that was bought will now be shown as an asset on the farm schedule, and there'll be a depreciation related to that flowing through on the farm. So the Schedule F, the farm schedule, is now going to be really ugly because it's probably going to show a big loss from depreciation, whereas before it wouldn't have shown that big loss. And then the schedule that shows the gain on the sale of equipment is going to show a big gain, which it used to not show either. So the farm tax returns are going to look really unusual. And I know we've got some bankers in the audience, and so I know our local bankers understand that and will know how to read a tax return and make loans and adjust loans accordingly. So depreciation is another biggie that changed recently under the new tax act. So most of you have a business, so you understand what Section 179 is. It's accelerated depreciation on assets that you buy. The limit used to be $250,000. So you could expense up to $250,000 of equipment, livestock, various qualifying assets that you bought. That limit has gone from $250,000 all the way up to $1 million. So that's kind of a big boon for farmers, because I know there's a lot of farmers in here, and you guys know the equipment's not getting any cheaper, right? So that's going to be huge for the farmers to be able to write off their new asset purchases. Most people are also familiar with bonus depreciation too, so it's another method of depreciation besides Section 179. In prior laws, you could only take bonus depreciation on a brand new asset, so you had to be the first original owner of that asset to be able to take bonus depreciation. And now you can take bonus depreciation on an asset whether it's new or used, doesn't matter. So, which is a great addition to the tax law. Bonus depreciation also used to be limited to 50%. So if you bought a $100,000 tractor, you could take 50% bonus depreciation or $50,000 of bonus depreciation. That's now changed to 100% bonus depreciation, so a farmer could write off the full $100,000 of the new asset under bonus depreciation. So another real benefit to farmers too, and this impacts farmers only, is most farm equipment was depreciated on a 7-year life, over a 7-year life. But this new law said that farmers, if you buy a brand new piece of equipment, you can now depreciate that over 5 years instead of 7. So you recover your costs and get tax deductions quite a bit sooner. So you're accelerating those tax benefits, which will hopefully lead to better cash flow that you can reinvest in your farm and keep building your farm. So, and the last thing with regards to depreciation that changed with farmers is most farmers used to depreciate their assets in what we call 150% declining balance method, which it front-loaded depreciation more into the first 3 or 4 years, and then you got less over the years 5, 6, 7. But now farmers get to use 200% declining balance, which puts even more depreciation in those first couple of years. So farmers really get a whop on depreciation early when they buy that asset. Landlords, we have a lot of landlords in here. So when you're a landlord, there's 2 different ways to generate income from your land if you're renting it out. You can either collect cash rent or you can crop share it. As I mentioned earlier, the new tax law, it's still in a lot of ways in skeleton form. We don't know all the answers yet. One of the things we don't know is for people who are cash renting their property, do they get a 20% deduction on the net rental income of that property? We don't know yet. We're hoping we do, because that'd be a great boon to the taxpayers. But there's no bright line, what we call a bright line test yet. So that's to be determined. However, it does appear that if you crop share your property and you share in the expenses of the farm, you do qualify for that 20% deduction on the net profit from that activity. So that's a great thing for landlords. Drought relief. Some of the counties around here experienced droughts and actually qualified for federal assistance. Others didn't. So I put that in there just to kind of make you aware. We'll look, for our clients, we'll look and see if the counties that you farm in qualified for any drought relief or not. There's certain provisions that farmers can defer income into a future year if they experience a drought. So we want to take advantage of those if we can. Farmers also have a special rule that as long as they file their tax return by March 1, they don't have to pay, and they pay their tax by March 1, they don't have to file or pay any estimated tax payments in during the year. So you can hold on to your cash, use it in your farm to grow it. But that may change a little bit this year because we're expecting delays in IRS tax forms. And we're probably not going to be able to file by March 1 because the forms aren't going to be ready. IRS computers aren't going to be programmed yet. So what do? Well, we're hoping that the IRS will extend the filing deadline for farmers past March 1, but we don't know if they will or not. So another thing that farmers can do is they can actually estimate the tax they think they're going to owe with their tax return. And as long as they pay it by January 15th, they can avoid estimated tax penalties or reduce estimated tax penalties. So keep that in mind. So farmers may need to make a payment by January 15th of 2019. So what are some other things you should be looking at doing now based on these new tax laws? Well, most of you, if you're drawing a wage from employment somewhere, you notice that at some point during the year, early in the year, your paycheck probably increased a little bit. So the IRS changed the withholding tables during the year to factor in these new tax laws and lowers tax rates to put more money in the consumer's pockets. But what we've been finding out is that those tables weren't quite accurate, and so some people may have not had enough withholding taken out, and so if you typically experience a refund, you may not get that refund this year. You may actually owe tax, or your refund is going to be smaller. So we recommend a couple different things. Check your W-4. You can always change your W-4 and change your withholding elections. And just a safe solution, if you don't want to mess with any calculators or anything, a safe solution is just claim 1 to 2 fewer allowances than you typically do. There's also on the Missouri Department of Revenue website and the IRS website, they have some withholding calculators you can actually get on and play with and see if you need to change your withholding or not. So we're closing in towards the end of the year. Most employees have a couple months of payroll left within the year. So it's probably a good idea to check your withholding and make sure you don't need to update that, so you don't have a surprise tax bill when you file your tax return. Capital gains. So capital gains, we've experienced some extremely low capital gains rates over the past several years. Capital gains and even dividends, for that matter, can be taxed as low as 0% for federal tax purposes. States have their own capital gains tax rates, but this is all based on federal tax. So capital gains and dividends could be taxed as low as 0%, which is huge. They could also be taxed at 15 and 20% depending on what the rest of your income looks like. So it's important to take advantage of these 0% capital gains rates if you can. You can do that in a lot of different ways. A lot of you are business owners. You have equipment that you could sell and maybe potentially pay 0% capital gains rates. Some of you have investments, stocks, mutual funds that have some gain in there that you could possibly sell and take advantage of that 0% capital gains rate. So this is a great time to restructure some investment portfolios if you have such. It's important to point out too that qualified dividends, there's two types of dividends, ordinary and qualified. Qualified are the only ones that are taxed at capital gains tax rates. So this is kind of an example of how we help our clients maximize the capital gains tax laws by minimizing their capital gains tax. I won't walk through this formula with you. It's in your slides. But if you're going to experience a capital gain during the year, come see us because we can help you. We want to make sure that you pay the lowest rate, possibly 0% on your capital gains. All right, let's kind of switch over to child and family credits now. There's a lot of changes with regards to this, mostly for the better. So as I mentioned earlier, the personal and dependency exemptions are wiped out. They exist no longer under the tax law, at least through 2025, or until Congress changes their minds again and changes the law. So the personal exemption used to be $4,050 per dependent on your tax return, which saved most taxpayers an average of $600 to $700 per dependent. Like I said, that is gone, so that's no longer there. But that's also been replaced with a child tax credit. So if you have a child that's under the age of 17, they could have potentially qualified for a $1,000 credit in the past. Now they can potentially qualify for a $2,000 credit. So the credit for having a child on your tax return doubled to $2,000. There's also something new too. Typically, the year your child reached the age of 17, you didn't get a child tax credit for them. But this new law put in force where your child can actually, or you can actually receive a $500 credit in the year that your child reaches age 17. So we'll actually get the benefit from that this year, won't we, Ashton? So awesome. And then they also put a new $500 credit in for other dependents and kids that are 17 years or older. And when I say other dependents, that could be a parent that lives with you. I hope to God that never happens. So, oh shoot. And it's important to point out too that the regular child tax credit is partially refundable. The new $500 credit for other dependents is not refundable at all. So there's also big changes in AGI stands for adjusted gross income. So there's big changes in the phase-out limits with regards to these credits we just talked about. So under the old law, if you're married and your income, once your income hit $110,000, you started losing that $1,000 credit, and it phased out pretty quickly. So the new tax law has a much higher phase-out threshold. So the new law says that if you're married, you can make $400,000 before you start losing your credit on your children on your tax return. So in short, the credit got doubled. There's a new credit, and it seems like everyone gets a credit now if you have a kid. So those are all good changes for the taxpayers. So who qualifies as a dependent on your tax return? Well, there's several different categories. Qualifying child includes, your son, your daughter, could be stepchildren, foster children, could even be sister, brother, stepsister, and even their children as well. So to qualify for some of these credits that we talked about, the person must be claimed as a dependent on your tax return, and the child cannot provide more than half their own support. So if they provide more than half the support, you're kind of toast. Hopefully this one doesn't apply to any of you in the room. It's always a contentious subject, never a fun subject to talk about, is alimony. So in the old law, the spouse paying the alimony got to receive a tax deduction for their payments, and the person who received alimony reported that alimony as income and paid tax on it. That's no longer the case. So whoever's paying the alimony no longer gets a tax deduction, and the recipient doesn't have to pay tax on it. Now this only applies to divorces that were finalized after December 31st, 2018 and met these other agreements. So make sure, if you do go through a divorce, make sure you pick an attorney who understands this and factors taxes into the alimony structure. Moving expenses. You used to be able to deduct moving expenses if you met certain criteria. Easy, Rhonda. She doesn't need your advice, believe me. So moving expenses are no longer deductible except for certain military members. So, and that was for effective for years after 12/31/17. The old educator deduction. How many educators do we have in the room? Do we have any? I know we have some former educators. Yeah. Well, I guess you're still educators. You're just not actively educating in the classroom anymore. So, $250 seems like a small deduction, but you would not believe how I've heard horror stories from other CPAs where they forgot to take this $250 deduction on a tax return, and their teacher client was all up in arms. And some practitioners even lost clients because they didn't claim this $250 deduction for their teachers. So be aware that they actually indexed it for inflation, and you can see the criteria to see whether you qualify or not. But it's important to notice too that homeschooling costs are not included in there. Medical deductions. Most people don't have enough medical deductions to take a tax deduction for those. If you do, you probably didn't have the best year, and you hope you never have a year like that again. So in 2017, there was originally supposed to be a 10% floor for Americans to deduct their medical expenses. And what that 10% floor means is basically you look at a client's income on their tax return, take it times 10%, and their medical expenses have to exceed that amount to be able to deduct them. 10% is a pretty high dollar threshold. And that's changed now for 2017 and 18. They actually moved that 10% back down to 7.5%, so you don't have to have quite as many medical expenses to be able to use them on your tax return. So, but this last bullet point is pretty important. So if you do have some major medical expenses, make sure you call us, and if we're not your CPAs, we aren't your CPAs, call your CPA, your tax professional, because there may be some strategies that need to be employed to make sure you get the benefit from those medical expenses. Medical expenses, what qualifies as a deduction. We won't walk through all of these, but basically anything for the diagnosis, cure, treatment, or prevention of a disease, as well as your health insurance, it also qualifies as well. Some things that are non-deductible: cosmetic surgery, over-the-counter aids, amounts paid through your health reimbursement account, your flex account, or your health savings account. You've probably seen a lot of headlines about this next section we're going to talk about too. And the headlines, most headlines we saw were in regards to residents of New York. New York has pretty high state income taxes. So now, if you itemize your deductions, your state and local taxes, which include state and local income taxes and your real estate and personal property taxes, is limited to a $10,000 deduction. So there's a lot of people in New York that pay a lot more than $10,000. I mean, $10,000 on some of those houses in New York's property tax-wise is minuscule. So a lot of the residents of states with high income taxes are really going to get burned by this $10,000 limitation on state and local taxes. Mortgage interest, they've had some major changes too. This limitation probably won't impact as many people in the Midwest as it does some people on the coast, but it's still a big change that you should be aware of. So one, interest paid on a home equity debt is no longer deductible as of January 1st, 2018, unless it's used to buy, build, or improve your home. And then for new loans or loans modified after December 15, 2017, you can only deduct the interest on the first $750,000 of your mortgage. So if you have $1 million mortgage, you're missing out on the interest on $250,000 of that loan. So that's pretty significant. These rules are actually very complex. There's a lot of moving parts to them. And so as a tax practitioner, we have to ask these three questions just to be able to tell if we can deduct mortgage interest or not anymore. First one being, did you refinance or draw on an equity line, equity line this year? When did you do it and how much did you draw? And what was the money used for? So. Casualty and theft losses. This is one of those provisions of the tax law that Congress put in there years ago. They didn't really intend for anyone to use it. We've rarely seen a casualty or theft loss, a personal casualty or theft loss, be deductible in a tax return. There's so many restrictions and thresholds you had to meet to be able to deduct it. So removal of this from the tax law really has no real impact on most of our clients. Gambling losses. I know there's some big gamblers in here. So you can still deduct your gambling losses.
Yes, I can mark it.
Amen to that. Amen to that. So for you gamblers, you can still deduct your gambling losses up to the amount of your gambling winnings in essence. So charitable contributions. This top one is a big deal. So if you went to a big state institution, you're probably still a big supporter of your state institution. We have a lot of Mizzou Tiger fans around here. A lot of our clients bought season tickets and had seating rights at football games, basketball games. So in the past, you could deduct 80% of the cost of the seating rights when you paid for those seating rights. That's no longer the case. You get no deduction anymore. So this is probably going to have a pretty profound impact on a lot of the state universities. They may see fewer dollars flowing in if people can't deduct them from their taxes. So it's also important to point out too that the large increase in the amount of deductions now needed to itemize may require you to bunch your charitable contributions into 1 year. So we talked about the standard deduction doubling. So if you're married taxpayer filing a joint return, your standard deduction is now $24,000. It's going to take a lot of charitable contributions, a lot of medical expenses, and mortgage interest to get to that $24,000 level. So you may want to employ a strategy where you may give 2 years worth of gifts in 1 year, none the next year, and so on and so forth, just so you can get some tax benefits from your charitable contributions. So we can obviously help you plan for this. Just let us know. This 2% miscellaneous itemized deduction is a big deal for several industries. So there are a lot of different workers out there that they may get a wage from their job, but they're responsible for paying. They may be traveling and selling something, so they're responsible for paying for their own auto expenses, their own lodging, their own meals. And if you're an employee and had to pay for those expenses in the past, you could deduct those as an itemized deduction on your tax return. But those have been completely eliminated. So those people get no deductions anymore at all for their meals and out-of-pocket costs while they're traveling and working for someone else. So that's a big one. If you're in that kind of situation, get a hold of us. We're glad to talk to you and or your employer. There's ways to work around this. Change your employment agreement and some things like that so that you can still get those deductions. Other things in this 2% itemized deduction category, investment advisory fees. So those are basically no longer deductible. Hobby expenses, tax preparation costs, legal fees, and the big safe deposit box rental. I know that's a big revenue generator, isn't it? All $20 for that safe deposit box is no longer deductible. So what are some of the planning ideas? So in regards to the employee who's traveling around selling, paying for hotels and meals and gas for their vehicle, you can try to set up what we call an accountable plan with your employer to where they actually reimburse you for those costs. With regards to your IRA fees, I've never seen an IRA custodian that doesn't charge an annual IRA fee. Instead of writing a check to pay those IRA fees, now just have those deducted out of your IRA account directly. So that way you don't have to worry about missing out on that deduction. You're essentially getting a deduction if you pay it out of your IRA because you just reduce the value of your IRA by the amount of that fee. We're really good at doing this, allocating tax prep fees appropriately on a tax return. An example of this would be we got a client, they've got a farm, they've got a rental property, and they've got maybe a W-2 wages. So part of the tax preparation fee obviously applies to just filing their tax return, just the basic preparation. But there's also some additional cost to prepare those business schedules, so the farm schedule and the rental property schedule. So we are very tedious in our practice about taking their tax preparation costs and allocating some to the farm and some to the rental property. That's not always the case. I was actually reviewing some tax returns on a prospective client today. They were prepared by a firm in Kansas City. They allocated no tax preparation fees for this client to any of their business schedules, none. So the client essentially deducted none of their tax preparation costs. So that's just money clients are leaving on the table, and they don't even know it. So if you have a hobby, turn that hobby into a business so that those expenses don't fall underneath this 2% category. 529 accounts. How many of you have a 529 account for child, grandchild? Anybody in here have any of those? Well, these are one of the greatest ways to save for, under the current tax law, one of the greatest ways to save for historically college. But this new tax law expands the use of these 529 accounts, which is huge. So you can now use these any 529 funds for high school and elementary education in addition to college. So it's limited to $10,000 per student, and you can use it at a private school, a public school, a parochial school, doesn't really matter. You cannot use it for homeschool expenses though. So we're fortunate in our community to have a lot of different choices when it comes to schools. We have at least 3 private schools in our little community that charge tuition. So the parents of those, parents and grandparents, other family members can actually set up 529 accounts now and funnel the tuition for those schools through the 529 account and potentially receive some state income tax savings for that. So this is a huge, huge change in the tax law. Student loan debt forgiveness, we don't see this very often, but if you have cancellation of debt income because of the borrower's death or total impairment disability, it's exempt from tax after 12/31/17. The old insurance mandate. So everybody's familiar with the Affordable Care Act and all it's created a lot of headaches in a lot of different ways. It's helped a lot of people as well. But it created an individual insurance mandate. So if you didn't have health insurance, we had to ask every client when we prepared tax return whether they had health insurance or not. And we actually documented, usually made them show proof one way or the other. If you didn't have health insurance, you got hit with a penalty. So the new tax law changes this a little bit. So the requirement to have health insurance is still there. There's no enforcement for it. And the penalty still applies for 2018, but after 2018, that penalty's gone. But we have to be careful for this last bullet point. Some states are considering implementing their own penalties if you don't have health insurance. So we haven't seen anything happen in Missouri yet, but it could happen. So just be aware. Roth characterizations. So there are times where people have a traditional IRA. They may convert it to a Roth IRA, and by doing so, they incur a taxable event. The old law would allow you later in the year to say, you know what, I shouldn't have done that. Let me undo that Roth conversion, so I'm going to recharacterize that back to a traditional IRA. Well, some of those abilities have been eliminated. So now if you convert an IRA to a Roth, you got to make sure you really want to convert it to a Roth, because it's hard to undo at this point. There's still a few backdoor ways to do it that we're aware of, but in general, those are choppy waters to watch out for. So AMT, I talked about the AMT a while ago. So this is the separate tax system. So when we filed your tax return, we looked at regular tax and AMT tax. And if AMT was higher, you had to pay some additional income tax in the form of AMT tax. Well, the new tax law increased the exemption amount for AMT significantly. The income phase out changed significantly. So in short, there's going to be very few people that get hit with AMT. And this really was a big problem area for many, many years. AMT actually started a long time ago. A little history on the AMT and why it exists is, way back in history, there was a group of Americans that found ways to avoid paying income tax. They'd have tax-free bonds and certain forms of income that didn't generate any income tax. And so they had all this income they never paid tax on. So Congress implemented this AMT system and said, well, if you're not going to pay it under the regular tax system, we're going to pull these certain types of income into this AMT system. We're going to have you pay some tax. Well, that was all fine and dandy, but Congress very rarely indexed, as time went on, indexed the phase out and the AMT exemption amounts for inflation. So people, over the past couple of decades, you could have a small amount of income and be hit with AMT because of the lack of index inflation in the calculations. So luckily, that's kind of gone by the wayside for most people, and most people won't get hit with AMT anymore. Estates and gift taxes. There's been some really significant changes in this area as well. So estate, GST, and gift tax exemption amounts have increased to $10 million per person. It's inflation adjusted from 2012 onward, which makes the estate tax exemption $11.2 million per person that passes away. This is great news for a lot of our small businesses, our family farmers. There's a lot of farmers that have a lot of their assets tied up in land, and when they passed away on the old laws, their family is going to be burdened with paying some estate tax. Well, under current law, that's going to be a lot more rare. So they also have this portability provision in place too, so that if you're a married couple, between the two of you, you basically have $22.4 million of assets you can leave to your heirs estate tax free. So there's going to be very few people in the country that are hit with AMT anymore, and they're expected to only have about 1,800 people actually need to file an estate tax return. So the other good thing about this, so not only did the exemption for your estate increase, but what we call the basis step up was also retained. Do you guys understand what that means when I say basis step up? So essentially, let's say my wife Dawn and I have some Bank of America stock, and we co-own it together. It's worth $1,000. We paid $100 for it. So the guy always dies first. I'm going to kill myself off first. So I pass away, leave the Bank of America stock to Dawn. So so she already owned half the stock. With our original basis being $100, she's allocated $50 of original basis. And she has $500 of the $1,000 market value. But on the day that I pass away, she can actually what we call step up the value of my half the stock that she receives, meaning that instead of having my $50 basis and half of those shares, she now gets half of the $1,000 value or a $500 basis. So her basis in that stock went from $100 between the two of us to $500 from me plus $50 of her original basis. So she gets a $550 basis in that stock versus $100. So it's a pretty significant benefit to the heir or surviving spouse. Actually, and that's all we had today. So we touched on a lot of stuff. As you can see, there's a lot of changes in tax law, and they're pretty significant. There's some loopholes. There's also a lot of pitfalls to fall into and traps. So as I alluded to earlier in my presentation, this is the year to engage a qualified tax professional to help you with your taxes if you don't already have one. Otherwise, you're going to be leaving money on the table. So I want to thank you all for coming. We appreciate it. We're very pleased with the turnout. And once again, Chad, thank you for putting all this stuff together for us and running logistics. And we'll be around for questions afterwards, so you're glad to ask some questions.
Hey, I got a question.
Uh-oh.
Is there any specific new deductions for expenses related to participating in a state tennis tournament?
Yeah, that's a good question. If there isn't, there should be. I agree. So That's a great question. Thank you for bringing that up. So, all right. Well, thank you all for coming, and we'll be around for questions, or I'll be around for questions if you have any.